Listen, if you're watching silver right now trading at $85.91 per ounce and thinking the party's over, you're seeing exactly what they want you to see. What happened on January 30th wasn't a market crash. It was a controlled demolition. And I'm about to show you proof that makes it impossible to deny. Silver dropped 33% in a single trading session, plunging from $121 down to $76, and it was the second worst day in silver's history. But here's what nobody's talking about. The CME Group announced a massive 15% margin requirement increase on the exact same day the crash happened. Not before, not after market participants had time to adjust. On the same day. That's not coincidence. That's a kill switch being activated in real time. And if you don't understand what that means, you're about to get a lesson in how the game is really played. Before we dive deep into this, I need you to do something for me right now. Hit that like button, smash subscribe, and turn on notifications because this channel is tracking the biggest wealth transfer event of our generation and you don't want to miss what's coming next. And drop a comment below telling me where you're watching from and what time it is, where you are. I want to see how global this audience really is. Are you in Texas, California, London, Sydney, Mumbai? Let me know and tell me what you think about this crash. Did it scare you? Did you sell? Or did you see through it like I did? Comment section is open. Let's build this community together because mainstream media sure isn't going to tell you the truth about what just happened. Alright, let's get into this because the timeline alone is damning. On January 29th, silver hit $120.45 per ounce. That's a record. That's silver doing something it had never done before in history. The physical market was in absolute chaos. Dealers couldn't source inventory. Shanghai premiums were over $14 per ounce above spot. COMEX registered vaults had been drained by 70% since 2020. Every indicator was screaming physical shortage. And then January 30th happens. Silver opens strong, pushes above $121, and then suddenly, at 10:30 a.m. Eastern Time, the bottom falls out. Within hours, silver crashes to $76. That's a $45 drop. That's 33% of its value evaporated in a single session. Trillions of dollars in market value wiped out. Margin calls triggered across the board. Algorithmic trading systems hit stop losses in cascading waves. Absolute carnage. And then, right in the middle of that bloodbath, the CME Group issues a notice. Silver margin requirements are being raised from 11% to 15%, effective February 2nd. Gold margins going from 6% to 8% across the board. They're making it more expensive to hold futures positions right when the market is collapsing. Now, most people would look at that and think, okay, the CME is responding to volatility. That's what they're supposed to do, right? Manage risk? Protect the clearing system? Standard operating procedure? Except here's the problem with that story. The crash happened first, and then they announced the margin hike. But if you look at when that decision was actually made, when those documents were prepared, when that machinery was set in motion, it had to happen before the crash. You don't draft exchange policy documents, get legal approval, prepare system changes, and issue public notices in the middle of a trading session. That takes planning. That takes preparation. This means the CME knew the crash was coming because they were the ones engineering it. The margin hike wasn't a response to the crash. The margin hike was the cause of the crash. And here's how you know. They didn't just raise margins once. They raised them multiple times throughout January, in a systematic pattern designed to squeeze leveraged traders. On January 7th, they hiked silver margins by 47% to $32,500 per contract. The market absorbed it and kept rallying. On January 27th, they raised margins again from 9% to 11%. Market kept going up. By January 30th, they'd raised margins enough times that leveraged traders were already on the edge. They were fully loaded, max positioned, and running out of liquidity to meet margin calls. All the CME had to do was pull the trigger one more time. And they did. And the entire leverage structure collapsed like a house of cards. But here's the really sick part. After the crash, after silver had already fallen 33%, they announced another margin hike for February 2nd. Think about that. You've just witnessed the second worst crash in silver history. Prices have fallen from $121 to $76. Volatility should be declining. Risk should be reducing. And what does the CME do? They raise margins again. From 11% to 15%. That represents a total increase of 35% in margin requirements from the pre-crash levels. Why would you raise margins on the way down unless your goal isn't to manage risk, but to prevent recovery? Because that's exactly what this is. The margin hike on the way down is designed to keep traders from buying the dip. It's designed to prevent the market from bouncing back. It's designed to force maximum liquidation and maximum pain. And that is not risk management. That is market manipulation. Now, if this sounds familiar, it should, because they've done this before. Twice. Let me take you back to 1980. Silver had rallied from around $6 per ounce to nearly $50 in January of that year. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were accused of trying to corner the market. Whether they actually did or not is debatable, and the evidence suggests they didn't. But what's not debatable is what happened next. On January 21, 1980, the COMEX implemented Silver Rule 7. That rule restricted trading to liquidation only, no new longs, only selling, and they raised margin requirements massively. Silver collapsed from $48 to under $11 within months. It was called Silver Thursday. March 27, 1980. The Hunt brothers were bankrupted. Tens of thousands of investors were wiped out. And the banks that were short silver, the ones who would have lost billions if silver kept rising, they were saved. Same playbook, same weapon. Margin requirements used as a kill switch to crash the market when it goes against the institutional players. It happened in 1980. It happened again in 2011 when silver hit $49 and the CME raised margins 5 times in 8 days, crushing silver back down to $26. And now it's happening again in 2026. This is the third time in 45 years they've used this exact tactic. At what point do we stop calling it coincidence and start calling it what it is, a design system to suppress price when it threatens the established order? And let's talk about who benefits from this, because it's not random. The CME Group isn't just an exchange. It's a for-profit corporation that generates revenue from trading volume and clearing fees. They have relationships with the biggest banks and trading firms on the planet. JP Morgan, the bank that was fined $920 million in 2020 for spoofing and manipulating precious metals markets for 8 years. They're a major player on the COMEX. Their traders went to prison. The Department of Justice, the CFTC, the SEC, all of them documented that JP Morgan was manipulating silver and gold prices through thousands of illegal trades from 2008 to 2016. That's not conspiracy theory. That's court record. That's settlement agreement. That's proven fact. So when silver starts rallying to levels that threaten short positions, when physical demand creates a squeeze that could force delivery failures, when the paper market starts to lose control of price discovery, who do you think benefits from a sudden crash? The traders who are long and riding the rally up, or the institutions who are short and facing potentially unlimited losses if the squeeze continued? Here's another piece of evidence that this crash was engineered. Look at what happened to the physical market. On January 30th, when paper silver crashed 33%, did physical premiums collapse? Did dealers suddenly have abundant inventory available at spot price? No, physical markets barely budged. Dealers are still requiring 5 to 8 business days just to confirm orders. Lead times haven't improved. Premiums are still elevated. The physical shortage that existed before the crash still exists after the crash, because the crash didn't happen in the physical market, it happened in the paper market. And that disconnect tells you everything you need to know about where the manipulation is occurring. Paper silver is infinite. You can create futures contracts out of thin air. You can sell contracts that represent metal you don't own and have no intention of delivering. You can pile on short positions until the weight of them crushes the price. And when everyone's using leverage, when everyone's trading on margin, all you have to do is raise the margin requirements and force liquidation. That's the kill switch. That's the weapon. And the CME just proved they're willing to use it. But physical silver, you can't create that out of thin air. You can't print more of it. You can't margin call it into existence. Physical metal is finite. And when the COMEX registered vaults are down 70% since 2020, when Shanghai inventories are draining, when dealers can't source product, that tells you the real story. The physical market knows silver is scarce, the paper market is pretending it's abundant. And when those two realities collide, the paper market uses manipulation to force prices down temporarily. But temporarily is the key word, because here's what they can't fix. The supply deficit is real. Industrial demand isn't going away. Solar panels still need 20 grams of silver each. Electric vehicles still need 25 to 50 grams per unit. 5G infrastructure, AI data centers, military applications, medical devices, all of it requires silver. And mine supply isn't keeping up. Recycling can't fill the gap. The structural shortage that drove silver to $121 is still there. The crash didn't change fundamentals. It just shook out weak hands who were trading on leverage. And that's exactly what this was designed to do. This wasn't a natural market correction. This was a false flag operation to scare retail investors out of the market right before the next leg up. Think about the psychology of what just happened. You've got millions of people who watched silver rally from $30 to $121. They finally got convinced to buy in. They opened futures accounts. They bought call options. They went long with leverage thinking silver was going to $200. And then boom. 33% crash in one day. Margin calls. Forced liquidation. Total panic. How many of those people are ever going to touch silver again? How many of them just learned that precious metals are too volatile, too risky, too manipulated to be worth the trouble? That's the point. Scare retail out, shake weak hands, let institutions accumulate at lower prices, transfer wealth from the uninformed to the informed, from the leveraged to the cash buyers, from paper traders to physical holders. That's how the game works. And if you don't understand that, you're going to be on the wrong side of the biggest transfer of wealth in modern history. So let's talk about what you should actually do with this information. First, understand the difference between paper silver and physical silver. If you are trading futures with leverage, you just learned a very expensive lesson about counterparty risk and manipulation risk. Futures markets are controlled by the CME. They set the rules. They change the rules. They enforce the rules. And when it benefits the institutional players to crash the market, they have the tools to do it. Margin requirements are the kill switch, and they just showed you they're willing to flip it. But if you're holding physical silver, coins or bars in your possession, or in allocated storage where you have direct ownership, what happened on January 30th didn't affect you. Your metal didn't disappear. Its value didn't change fundamentally. The paper market threw a tantrum, but physical reality is unchanged. The supply deficit is still there. Industrial demand is still there. The next crisis is still coming. And when it does, physical metal is what's going to protect your wealth. Second, recognize this crash for what it was, an opportunity. I know that sounds crazy when you just watch 33% get wiped out in a day, but think about it. If the fundamentals haven't changed, if the supply shortage is still real, if industrial demand is still growing, if geopolitical risk is still elevated, then a 33% price drop created by paper market manipulation is a gift. It's a chance to acquire physical metal at prices that won't last, because the CME can control paper prices temporarily, but they can't create physical supply. They can force traders to liquidate futures contracts, but they can't make more silver appear in dealer inventories. And the physical market is already telling you that truth. Premiums haven't collapsed. Lead times haven't improved. Dealers are still struggling to source inventory. The disconnect between paper price and physical availability is wider than ever. And that disconnect is the proof that this crash was artificial. Real market corrections happen when supply exceeds demand. This crash happened when demand still exceeds supply. That's not a correction. That's manipulation. Third, understand the timeline of what's coming. The CME's margin hike takes full effect on February 2nd. That means we're in the immediate aftermath right now. Traders are still digesting what happened. Some are licking their wounds. Some are trying to figure out if they want back in. Some are done with futures forever and looking at physical. This is the transition period. And during transition periods, you get opportunities because the leverage money got shaken out, but the fundamental demand hasn't changed. Industrial users still need to buy. Jewelers still need inventory. Electronics manufacturers still need supply. And all of those buyers just got a 33% discount, courtesy of the CME's manipulation. So they're going to buy. And when they do, the physical market is going to tighten even more. And eventually, the paper market is going to have to acknowledge physical reality. Because you can only manipulate prices so long before the disconnect between paper and physical becomes so extreme that the paper market loses all credibility. We saw glimpses of that in January, when Shanghai premiums hit $14 over spot. When dealers couldn't confirm orders, when COMEX registered vaults were nearly empty, The system was breaking. And this crash was the emergency brake to buy more time. But time is limited, because every day that goes by, more solar panels get built, more EVs get manufactured, more industrial silver gets consumed and never recycled. The supply deficit gets bigger, the crisis gets closer, and the next time silver rallies, it's going to be harder to stop. Because traders who got burned this time will be smarter. They'll use less leverage. They'll hold physical instead of paper. They'll be prepared for manipulation, and the CME's kill switch will be less effective. That's why this crash is actually bullish long term. It's shaking out the weak hands now before the real move happens. It's teaching people lessons about paper versus physical. It's exposing the manipulation for everyone to see. And it's creating buying opportunities for those who understand what's really going on. Now let me address something that might be going through your mind. If the market is this manipulated, if the CME can just raise margins whenever they want and crash prices, why would you ever invest in silver? Why not just avoid the whole thing and stick with stocks or real estate or crypto or whatever else? And that's a fair question, but here's the answer. The manipulation proves how important silver is. They don't manipulate things that don't matter. They don't spend billions of dollars suppressing prices of worthless commodities. They manipulate silver because silver is critical. It's critical to industry. It's critical to technology. It's critical to the monetary system as a store of value and competition to fiat currency. The very fact that JP Morgan paid $920 million in fines, that traders went to prison, that the government documented 8 years of spoofing and manipulation, all of that proves silver matters. If it didn't matter, they wouldn't bother manipulating it. But they do bother. They bother a lot. And that tells you that when the paper manipulation finally fails, when physical reality overwhelms paper games, the price movement is going to be explosive, because all that suppressed demand, all that accumulated shortage, all that deferred price discovery, it's going to express itself all at once. That's what happened in January, when silver went from $30 to $121. That was the market trying to find true price. That was physical reality asserting itself. And the only way to stop it was a massive coordinated manipulation using margin hikes as the weapon. But manipulation has a cost. It destroys trust in the paper market. It drives people toward physical. It exposes the corruption, and eventually it fails. Because you can't manipulate physical reality forever. You can manipulate perception. You can manipulate price discovery. You can manipulate traders, but you can't manipulate the laws of supply and demand indefinitely. And when this manipulation fails, when the paper market finally loses control, the people holding physical silver are going to be the ones who benefit, not the futures traders who got margin called out, not the options buyers who got their positions crushed. The physical holders, the people who took delivery, the people who own the actual metal, those are the people who are going to survive the wealth transfer that's coming. So what's my advice? If you're in futures, understand the risks you're taking. Understand that the CME controls the rules, and they can change them whenever it benefits their members. Understand that leverage is a double-edged sword, and margin requirements are a weapon that can be used against you. And consider whether you want to play in a rigged game, where the house can change the rules mid-hand. If you're holding physical, understand that volatility in the paper market doesn't change your fundamental thesis. Physical supply deficits are real. Industrial demand is real. The next crisis is real. And when the paper market finally breaks, physical metal is going to be what preserves and grows wealth. Paper promises are going to be worth exactly what they're printed on. Nothing. And if you're on the sidelines trying to figure out what to do, understand that crashes create opportunities. Not every crash is the same. Sometimes crashes happen because fundamentals deteriorated. Sometimes they happen because perception changed. And sometimes they happen because powerful players with control over market infrastructure manipulated prices to serve their own interests. This crash was the third kind. And when manipulation creates crashes, the opportunity is to buy the thing they're trying to suppress. Because if they're trying to suppress it, it must be dangerous to them. And if it's dangerous to them, it's probably valuable to you. The CME just activated the kill switch. They raised margins to force liquidation and crash prices. They did it in 1980. They did it in 2011. They just did it again in 2026. But here's what they can't do. They can't create more physical silver. They can't change the supply deficit. They can't eliminate industrial demand. They can't prevent the next crisis. All they can do is buy time, and time is running out. So here's my question for you. Are you going to let this crash scare you out? Or are you going to see it for what it really is? An engineered buying opportunity before the next leg up. Are you going to trust the paper price that can be manipulated with margin hikes? Or are you going to trust physical reality that can't be printed or controlled? Are you going to be the weak hand that got shaken out? Or the strong hand that accumulated while others panicked? That's the decision you have to make. And you don't have unlimited time to make it, because the physical market is already tightening again. Dealers are already reporting that the crash brought a wave of new buyers looking to acquire metal at lower prices. Shanghai premiums are still elevated. COMEX vaults are still depleted. Nothing fundamental has changed except the paper price got manipulated lower. And when you see this kind of disconnect between paper and physical, when you see manipulation this obvious, when you see the kill switch get activated in real time, that's not a reason to run away. That's a reason to pay attention. Because the things they work hardest to suppress are usually the things most dangerous to their control. And silver is dangerous to a system built on infinite money printing and debt accumulation. Silver is dangerous to a system where paper promises have replaced real assets. Silver is dangerous to a system that relies on perception management instead of physical reality. That's why they manipulate it. That's why they raised margins in the middle of a rally. That's why they crashed it by 33% in a single day. Not because silver isn't valuable, because silver is too valuable. And if the free market was allowed to discover true price without interference, that price would be far higher than $121. Maybe $200. Maybe $300. Maybe more. We don't know because they won't let us find out. But we will find out eventually, because manipulation always fails. Supply and demand always win. Physical reality always trumps paper games. And when that happens, the crash of January 30th, 2026 is going to look like the buying opportunity of the decade. Before I wrap this up, make sure you subscribe to this channel because we're going to be tracking this story closely. The aftermath of this crash, the response from the physical market, the next moves from the CME, the industrial demand picture, all of it matters. Hit that subscribe button, turn on notifications, and leave a comment telling me where you're watching from and what you think about what just happened. Do you see this as manipulation or legitimate risk management? Did you buy the dip or are you waiting? Are you holding physical or trading paper? I want to hear from you because this community is how we stay ahead of the manipulation and the mainstream narrative. And remember, this isn't financial advice. I'm not telling you what to do with your money. I'm giving you information and perspective that you're not going to get from CNBC or Bloomberg or your financial advisor who sees probably never even thought about physical silver. You have to make your own decisions based on your own research and your own risk tolerance. But what I will tell you is this. The crash was a false flag. The margin hike proves the kill switch was activated. And physical reality hasn't changed one bit. The people who understand that are going to be the ones who come out ahead. The people who panic and believe the manipulation are going to be the ones left behind. Choose which side you want to be on. Because this game is far from over. It's just getting started. Subscribe, comment, engage. And I'll see you in the next one where we'll track exactly what happens as this story continues to unfold.